Hello everyone. In this lecture, we shall be discussing equity risk premium, which is covered in chapter 5 of ASM, security valuation. Before starting that, let us discuss about few basics of investment in equity. See, we all know that investing in equity or shares is a risky affair, right? We all know that people lose money from investing in equity share market. But still, why do you think people invest money in equity shares? Definitely, it is because of the returns, right? Now, why is it key people go for returns in equity market when we have returns available in fixed deposit in SBI or a bank where there is much less risk? Obviously, the answer is the risk which we take while investing money in equity is rewarded by a higher return. The return in equity market is much higher than return an SBI FD will give, right? And this difference is the equity risk premium. The return which we get from an equity share, which is much higher than a return from an FD. So this, I would say, it is a risk-free return. And that differential return or the excess of return which we get from a share is known as equity risk premium. That is a premium in return which we get because of the increased risk which an investor is taking. So equity risk premium is the extra return that the investor receives from investing in the stock market compared to a risk-free rate. It compensates the investor for taking on the higher risk of investing in equities. So equity risk premium is the difference between the return on equity and return on risk-free rate RF. So ERP is the estimated expected return on stock minus risk-free rate of return RF. So why I call this as the estimated expected return on stock? It is not possible to completely present with 100% accuracy the return which we may get in the market or from an equity share. So that's why I call this as estimated expected return on stock. And RF is obviously the risk-free rate of return. It is the government bond or a fixed deposit. Usually we take RF as the long-term government security because these are considered as risk-free assets. Government securities which are long-term are considered as risk-free assets, and that is what we use to compare with the equity return and arrive at equity risk premium. Higher risk investments are compensated with higher ERP. If the return on this particular share is high, so as that the return from that equity will also be more, and ERP, the risk premium, will also be high. ERP varies in size and changes over time as market risk fluctuates. When the market fluctuates, both the equity return will keep changing as well as the risk-free rate in the market will also keep changing, and this will result in a different ERP. ERP is theoretical. It is impossible to know how well equities will perform in future. So that is why we call this as estimated expected return on stock. Now let us come to computing ERP. So to calculate ERP, we can use CAPM, capital asset pricing model. The formula for CAPM model is given as here. Now, see, CAPM model will be in detail dealt in other chapters. For now, let us only focus on this formula and try to understand formula because this will be used for computing ERP. Otherwise, in detail CAPM model will definitely be discussed in other chapters. Here, this formula Rx is equal to Rf plus beta into Rm minus Rf. Let us see what all are these various variants. Rx is the expected return on equity investment in company X. Suppose if I'm investing in a company X and the return from which I'm expecting from that company is Rx. Rf is the risk-free rate of return. RF is the risk-free rate of return, which is the long-term government bond. Now, beta X. Let us now try to understand what is beta. Beta is a measure of, suppose a stock, a share with beta is equal to 1. That means this is as risky as market. The share market as a whole has a beta of 1. So if I say a particular share, a single share in that market is having a beta of 1, that means this share is as risky as the market, the share market as a whole. Suppose if I say beta of that share is 2, that means it is twice as risky as the market. So always when beta increases, the share risk also increases. Beta is equal to 1 means it doesn't mean it is not risky. Risk, if beta is 0 means there is no risk at all. No, that is not the case. Beta is the correlation with the market risk of the market to the risk of that particular share. So if beta is 1, that means it is as risky as the market. Risk free is always our RF, which is the long-term government bond. We are only talking about the share here, and we are comparing the risk of the share with the risk of market. So one thing which you can conclude is if beta is high, that means the share is more risky. Now, RM is the expected return of the market as a whole, and RM minus RF is the market risk premium. RM is the return of the market, and RF is the risk-free rate, and then RM minus RF is the market risk premium. For investing in the share market as a whole, what will be the premium which I get? What will be the additional return which I get compared to the risk-free rate? That is market risk premium. Now, ERP, which is RX minus RF, which is the excess of that return compared to the risk-free rate, we can conclude from this formula that ERP is RX minus RF, which is beta into RM minus RF. So, beta of the stock into risk premium of market. This is the equity risk premium of stock. For a particular stock, how we can arrive at the equity risk premium is take the premium of the market as a whole and multiply with the beta of the stock. Take the premium of the market as a whole, which is RM minus RF, and multiply with the beta of the stock. This factor is not depending on stock, on that particular stock. It is a market factor. However, beta of the stock is completely dependent on that particular stock. So equity risk premium, ERP of a stock, is the market risk premium into the beta of the stock.